Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Amir Amel-Zadeh. Amir is associate professor at Saïd Business School and director of Oxford Rethinking Performance Initiative at the University of Oxford. Amir research broadly investigates the role of financial and non-financial reporting in capital markets and how companies' sustainability characteristic affect investors as assets allocations decision. He received his PhD in finance from the University of Cambridge. He has held visiting position at Harvard Business School, at the New York University School of Business, at Columbia Business School, and visiting professor at the University of Bologna. Amir is board member of the UK Endorsement Board, responsible for adopting IFRS for use by UK companies. He is co-editor of the European Accounting Review. Now we will start our seminar with dear Professor Amir Amel-Zadeh.
Thank you, Mohammed. Thanks for inviting me. I hope you can hear me well and you can see the slides. It's all good, great. It's a pleasure to be here. Please feel free, if you're online joining, feel free to turn on your cameras and let's have a conversation and interactive seminar. I'm happy if you want to interrupt me at any point in time with questions, comments. So this is a paper that is joined with Sirong, who's also on the call here, a former PhD student from Oxford, now at Bayes Business School, City University in London. And we are currently revising this this paper for submission. So any comments, anything you want us to change, add, anything interesting, any more cross-sectional tests you want to see, please feel free to suggest. So this is the time to essentially make these changes. Great. So this paper is essentially around about voluntary and interactions between voluntary and mandatory disclosure. And the way essentially this came about is for us to understand essentially how and whether voluntary and mandatory disclosures are essentially substitutes or complements. And there's a whole range of literature around essentially around this, but in particular, essentially around the earnings announcement, on the earnings announcement premium, that essentially finds, and this is across finance and accounting, where this literature finds that stock returns, that there are abnormal stock returns around earnings announcement. And this literature goes back, way back, even to the, if you want to essentially, to Beaver in 1968 to some extent. And after that, and I'll come back to essentially the literature and the discussion around what explains this earnings announcement premium. But really, what we're trying to understand is that what explains to some extent how voluntary disclosure, and in our case, we pick a particular one, which is management guidance, how management guidance or voluntary disclosure affects essentially the market reaction to mandatory disclosure, and in this case, to earnings announcements. So whether or not there is a causal effect essentially of management guidance on the earnings announcement premium. And this, to some extent, informs the debate about also about whether the information content. So there's a whole literature on this as well, and there's somewhat an academic debate between two camps, whether the information content of mandatory disclosure has essentially decreased over time because of the prevalence of voluntary disclosure. So as firms are disclosing more and more information voluntarily, whether or not essentially the information content of the mandatory disclosures has essentially decreased. And there are some papers out there, if you look at, that show essentially, if you look at the extent of the variation in stock returns over a quarter, they essentially show that a significant amount of that variation is explained by voluntary disclosure. And a big fraction of that is essentially explained by return volatility around management guidance. So management guidance, there's a lot of information on management guidance that is found in essentially a firm's quarterly stock return variance. So essentially in this study, we're trying to examine these interactions between voluntary and mandatory disclosure, and in particular, whether essentially management guidance has an effect on the earnings announcement premium. And whether that's one aspect or one factor that explains this trend in the declining earnings announcement premium or declining information content of mandatory disclosure. So this is essentially a graph that comes from our paper that we essentially also use to motivate the study. Is if you look over time, and this is during our sample period from 2002 to 2018, if you look over time, you see essentially an increase in voluntary disclosure, so guidance per firm per quarter, and somewhat a declining trend in the earnings announcement premium over time. And now the question is whether these trends are related and whether we can essentially find a way to establish that there's a causal effect of essentially the increase in voluntary disclosure on essentially decline in earnings announcement premium, which of course is very difficult to do because there's a host of other factors that might affect essentially earnings announcement premium. And I come back to what the literature actually tells us and the way when our identification strategy, are we trying to disentangle some of these effects?
A quick question.
Yes, James.
I don't quite see the downtrend there. I mean, if you start from 2004, which seems to be more natural, given the change in regulation, I don't see a downtrend.
I mean, somewhat, right?
I mean,
it's not strong.
No, right? but you're really making the case. This is what I like to see, and then you impose it. If you use a more open-ended eyes or prejudice, so to speak, if you start in 2004 and you go to the current 2018, I don't see any big change.
It's not a big change. There's some change to some extent.
Wow.
I think 2009 is an outlier given that risk premium increased dramatically during the financial crisis. So information uncertainty has increased. So you would essentially expect to see a higher earnings announcement premium. I come back to this, but you're right. I mean, obviously this is not like a super strong trend that is in our data. There's some, if you will, but also this essentially just relates to also the literature and the debate in the literature that essentially also documents that, or I should say a part of the literature that documents that there's a reduction in information content of mandatory disclosure, but it's not uncontentious. So I agree. So there's another part of the literature that essentially says the opposite, right? So that doesn't.
Yeah, correct.
So it's still in debate. I'll just show you essentially this trend line is essentially the trend line in the data. Now, of course, if you start here, that might be flatter, right? If you exclude 2009, it might look completely different, right? But is this just
yeah, regulation changed a lot in 2003.
That's true. Well, regulation changed obviously over time in 2002.
Yeah, but the big changes were in the early 2000s.
Yeah,
anyhow,
that's right. With Reg FD and the others, you're right.
Yeah.
Right. So this is not the main or the strong motivation of the paper to look at essentially what explains these trends.
Keep quiet.
Right?
Sorry.
No. I mean, valid point, right? This is not the main motivation. Essentially, if you think the time series explanation is not the main one. Essentially, our main tests and main motivation of the paper is to look at essentially what explains the cross-sectional variance, right? The variation in earnings announcement premium. But you're right.
I have another question just for why do you end at 2018?
I mean, we could go further, right?
Yeah, you could.
we can update the sample. That's not a big problem. I mean, I'm saying that because Sirong would have to do that. She's looking at me like, but it's essentially it's also related to when we started the paper, which was during
okay,
PhD times, right? But yeah, I mean, we could easily do that, get some more data. But let me show you what we actually do. So this is essentially the motivation of the paper, right? So we want to examine these interactions and particularly the effect of management guidance on mandatory earnings announcement, the reaction to mandatory earnings announcements, and to some extent also contribute to this debate on whether there's a loss in information content of these mandatory announcements. Now, there's a big literature on this, right? So in particular, across essentially finance and accounting, there's a significant literature on essentially what explains this earnings announcement premium, which is why we essentially started this paper, and which I found very surprising, is there's very little attention has been essentially played about the role of voluntary disclosure in affecting essentially the EAP, the earnings announcement premium, which to some extent, as an accountant or accounting researcher, is surprising. Maybe not so much that finance people don't pay too much attention to accounting, but it's surprising because you're essentially looking at information uncertainty around earnings announcement, and it's close to assume that any information disclosure before that earnings announcement would have an effect on that information uncertainty around the earnings announcement, if you believe that essentially this earnings announcement premium can be explained by, to a large extent, by some form of information risk around those announcements. And so essentially, this is what we essentially look at. And we look at what the effect is of mandatory management guidance that comes before essentially the quarterly earnings announcement, and whether the management guidance has then an effect on the information of that management guidance, has an effect on how markets react to the information around the earnings announcement. And the reason why we picked management guidance as one example of voluntary disclosure, you could pick others, right? I mean, some people say one could look at 8Ks, for example, although 8Ks are to some extent mandatory. You could look at press releases and so on. Is that essentially is because the prior literature has shown that management guidance explain a significant amount of the return variance of a given quarter, right? So there's a lot of information that is impounded into asset prices from these disclosures. So if we were to find an effect, it should be essentially it should be observable in management guidance. Now, and also, of course, there's this whole literature that looks at essentially the effects of voluntary disclosures on the information environment of the firm and reduction of information asymmetries, of the classical disclosure literature that we have in accounting. So it's close to look essentially at voluntary disclosures and what the effect they have on the earnings announcement premium. But again, it's surprising that there's fairly limited research on this. There's more and more research now coming out on these interactions between mandatory and voluntary disclosures, and in particular around also what explains the earnings announcement premium. And I'll come back to this in a second. Now, and this is essentially what we're trying to assess, is if you look at the prior literature that has tried to explain the EAP, there's essentially two camps. So if you think the risk-based explanations, and there's some behavioral explanations. Along the risk-based explanations, you can put papers into those that look at idiosyncratic risk changes around these announcements, and then systematic risk. So there's a whole literature that essentially suggests earnings announcements, right? There's an uncertainty that is associated with the information that is released during earnings announcement that leads to essentially an increase in information risk, which is non-diversifiable, idiosyncratic. And the reason that it's non-diversifiable is that because there's some form of friction in markets that prevents essentially efficient diversification. And this friction stems from liquidity trading. So it stems from a particular type of investors that trade ahead of the earnings announcement because for liquidity reasons and because they don't want to be exposed to that uncertainty. And this what they call asymmetric liquidity trading essentially increases risk for arbitrageurs and prevents them from essentially efficient diversification or from efficient diversification and from trading these abnormal returns away. So there's some form of friction that increases idiosyncratic risk.
I have another quick question
Please.
here. The EAP, as I remember it, it's all in smaller firms. Can you refresh our memories or my memory? Is there any EAP if you go to say if you go to S&P 500?
I think as far as I remember from the literature, it's actually in the cross section, right? You're right, it's larger in smaller firms just because the risk.
No, but it's much larger. In other words, as I try to refresh my memory, there are many of these studies, they do not quite sort out what's going on. In other words, the EAP is fundamentally very similar to the bid-ask spread. Is that right in your mind? Suppose you control for the bid-ask spread or something similar.
Yeah.
Do you still have an EAP effect?
Yes. Yeah,
Oh,
we do that.
Okay.
Yeah, we do have.
Thank you.
Yeah. And in particular, if I come to this paper down here, Savor and Wilson, Mungo, who's a colleague of mine at Oxford, so they actually show that the EAP is larger for larger firms, if you want, because
it's larger for larger firms.
Yeah, because the information spillovers they have to the rest of the market. So essentially, the argument here is, and this is why they argue that the AP can be explained by increases in systematic risk, is that announcing firms, so announcers essentially having spillovers of information spillovers over the rest of the market. So if you're an early announcer or the first ones that announces earnings, that essentially gives the market also information about all other firms, about the earnings of all other firms, in particular cash flow news of all other firms in the market, which then essentially increases your covariance, conditional covariance between the announcing firms and all the non-announcers, which then raises essentially that correlation raises the beta and raises the systematic risk of the announcing firm with the wider market, and this is essentially should be higher for firms that have more information spillovers or on the other market, which is essentially bellwether and larger firms. But so it's not quite clear, although.
Yeah. But thank you very much for laying this out. Yeah.
So and again, I don't think the determinants of the EAP have been essentially resolved yet, because that's one part of the literature that, and this paper in particular essentially builds a theoretical model and then shows it also empirically, so that it's mostly explained by.
It sounds ambitious. Yeah.
Increases in systematic risk, but it's not. I don't think that's a full story, right? Because you could, if you believe the essentially market friction, if there's also an increase in market friction, then your intuition is right. I think, James, that it would be much larger for smaller firms, right?
Yeah, I mean, again, I'm going to keep quiet, but I mean, I refresh my memory, and as I do that, the people have had difficulties in replicating some of the EAP work.
That too.
So in other words, what one really likes is sort of a simple and straightforward story. And in fact, we found that the literature has become more messy with more elaborate stories and more difficulties in what you may call replicating what has been done previously.
Yeah, and
So
then
thank you. Yeah,
reconciling
sorry. Yeah.
things. No, that's to some extent I agree with that. But there's always the question is how much of that variance are these different kind of determinants actually explaining, right? You can still reconcile some of that there might be some increase in information risk, idiosyncratic risk, as well as systematic risk. I'm kind of agnostic to that, and we are agnostic to that in that paper because we're trying to reconcile these different stories as well in terms of looking at how voluntary disclosure actually affects these channels, and I'll show you more on this in a second. So these are essentially the risk-based explanations for the AP. There's a whole other set of literature that says essentially, this is not increases in risk, this is actually behavioral, right? Because earnings announcements increase attention of investors, and that leads to essentially buying pressure around the earnings announcement. That buying pressure pushes up, provides this or explains this earnings announcement premium. And the reason why it's essentially buying pressure, irrespective of what the nature of the announcement is that investors are essentially exposed to or confronted with a universe of investable stocks, right? So there's like thousands of investable stocks. So for them they can't track all these stocks to decide which ones to buy. So what do? They use heuristics, and one of the heuristics is whatever that grabs their attention. Right? And this is usually firms that announce earnings. And this is asymmetric, so this only refers to purchases, but not the sales, because investors generally have a much smaller portfolio of firms, so let it be 20 firms, that they can track much easier if they wanted to sell, compared to essentially the available universe of buys that they have. So hence there's an asymmetric attention effect on buys, which essentially introduces a net buying pressure on announcing firms.
Wow.
And that explains some of the premium as well. So this is more an attention-based or behavioral-based explanation. Now, in our paper, we are actually kind of agnostic what the explanation is. We try to reconcile these two. So we are saying that if either of these channels actually exists, then we should see an effect of management guidance on information risk and systematic risk, but also on essentially attention, because if the attention-based explanation is valid, it should also essentially be for management guidance, that should capture some of the attention of investors, and hence could potentially also lead to buying pressure. But that also leads us to somewhat more of nuanced hypothesis around the nature of the guidance, so whether it's positive news or negative news, and I'll come back to this in a second. Now, in this paper then, so we're looking at how voluntary disclosure affects this attention channel and the information uncertainty associated with these mandatory disclosures. And in particular, we hypothesize that management guidance before the earnings announcement, right, affects both the information risk as well as investor attention through essentially these changes in the information environment of the firm. Because to some extent, the management guidance affects expectations of earnings and hence reduces information uncertainty of the schedule of the earnings announcement, because in effect, some of the information of the earnings announcement is pre-disclosed now in the mandatory guidance. And on the other hand, it essentially also raises investor attention and thus could contribute to this net buying behavior. So, and we essentially, and I come back to our hypothesis, but we essentially believe that the nature of the guidance might actually affect these two channels differently. So these two mechanisms, where you could imagine that bad news, so essentially a downward guidance, has a much larger information resolution effect because of the reliability that the market essentially assigns to negative disclosures, because generally managers are reluctant to disclose bad news. So there's, compared to good news, so there's a higher reliability value. But on the other hand, we also know from the prior literature that essentially bad news raises volatility, raises uncertainty. So the net effect is not quite clear, versus good news, where essentially the good news would reduce, could on one hand reduce information uncertainty, but also then raise investor attention and increase net buying on the other hand. As I said, there's a prior literature. Essentially, this literature kind of was ignited by a review article in the JE by Bayer et al., which essentially highlighted that there's a lack of empirical research on these interactions. There's been some analytical work. There's been actually some recent work last year that I need to add here as well, that looks, again, has started to look at the EAP and some behavioral explanations around investor behavior around these earnings announcements. So now, with any study on voluntary disclosure, there's obviously an issue with selection, right? Because managers self-select to disclose voluntarily, and that decision to disclose might be related to, say, the risk of the firm or the information risk, which might also be correlated with any earnings announcement premium. So, for example, managers might only voluntarily guide the market if it's easier to forecast earnings, and if it's easier to forecast earnings because the information, the uncertainty is lower, then the earnings announcement premium might also be lower. So that would essentially give us a negative correlation between guidance and the earnings announcement premium, which has nothing to do, essentially, which is endogenous, essentially. So in the way we try to alleviate this problem is by thinking about a setting which introduces exogenous variation to the voluntary disclosure decision. And what we're using here, and this is essentially borrowing from the prior literature to some extent, is index additions, and in particular S&P 500 index additions. So we're using S&P 500 index additions are essentially at the discretion of Standard & Poor's. They have certain rules. So Standard & Poor's has some market value, profitability, and other essentially financial metrics criteria that essentially they have publicly disclosed what they look at when deciding whether or not to add a firm to the S&P 500. But at the end of the day, it's their discretion whether and when they add the firm. So managers have no essential influence on it and can't predict whether they get added to the index, which is in contrast to, for example, Russell 3000 or Russell 1000 and 2000 index additions, which are pretty much mechanical based on market value, in particular index reshuffling dates. You know exactly which firm will get into the Russell 1000 and which firms will go down to the other ones. So, and this is helpful for our setting because we want them to be unpredictable, so not to be anticipated by managers. So what we do is we take essentially as treatment firms our first time S&P 500 index additions, and the reason, I forgot to mention, of course, the reason we do this and why this is, we believe this is introduces exogenous variation in disclosure is because there's prior literature that has essentially shown that firms that get added to the index, they increase voluntary disclosure, and this voluntary disclosure increase comes essentially from an unambiguous higher demand of index tracking funds for information. So there's all these index tracking funds that now have to essentially rebalance their holdings as a firm gets added to an index, and they essentially require more disclosure. These institutional investors require more disclosure, and that has been shown empirical empirically in the literature, and this is essentially what we also find in our data, that there's an increase in voluntary disclosure after index additions compared to essentially a control group that doesn't get added to the index. But what we do is now, yeah, sorry, yeah. Go ahead.
Oh, just a quick question.
Yes.
In your mind, does the dependent variable, the change in earnings announcement premium, must have a very large measurement error, subjectively in my mind? What is your sense of a measurement error in the dependent variable?
Yeah, so there is a measurement error, right?
Yeah, but is it big or relatively marginal, or what's your feeling about it? I mean, subjectively, for someone who doesn't work in the area, my sense would be that it's a very, very large measurement error, but you may see it differently.
Well, so I should.
In other words, to engage in this research question, which is generally kind of open-ended and vague, then the question arises, what is this dependent variable all about? And in particular, when you start to crunch the number, do you get the sense of that it's actually a fairly reliable number? Or do you get the sense, or maybe you see things differently? So if you would opine as you see it, that would be helpful, I think, from my point of view.
So I mean, it is an estimated number, right? I mean, it's
yeah, that's fair enough, of course.
Right, risk premium. But I think in this setting, as long as the error, the measurement error, is not systematic in one direction or the other, in our setting, it's not a big problem, because this
So
is
that's
actually
fair enough. But if the error is very large, basically you set yourself up for trying to explain something which is going to be very difficult to do.
True, but that essentially what you're saying then, that would introduce noise into our measure and potentially would essentially bias against us finding anything, right?
Yes, correct.
Right.
Yes.
Yeah, that's right. So it would essentially work against us. That's true. But I think in our setting, and this is, I need to explain this, this is not the change in the earnings announcement premium. This is actually this is already the difference estimator, right? So this is the difference in difference. I'll explain in a second. So
I understand that. Yeah.
So in a sense, if you believe that any measurement error is random across the treatment and the control group, right, then it should essentially, on average, then cancel out, right? Because we're differencing out essentially post minus pre for the treatment minus essentially the control group. But yeah, I mean, I think any study that uses an estimated value as a dependent variable has essentially to fail.
Well, I mean, again, I don't want to interrupt you, but my concern would be, as an amateur, that when you start to pose equation 1, you set yourself up because you have a very, very low R square.
Mm-hmm. Yeah, that's true. And this is, I think, if you look at
that would be my concern.
It's true. And if you look at most of the studies around the earnings announcement premium, how much of the variation they actually explain, it's not a lot, right?
No, it's minuscule.
Yeah. But you look at essentially, so this is close to, if you compare this to asset pricing studies in finance, so asset pricing regressions, you look at their R square, how much of a return, stock returns I actually explained is minimal, right? That's essentially the nature of these studies, of market studies. There's a lot of noise in there compared to, say, any other accounting or
I just really would like to know how you see it, because if we have very, very low R square, or something hard to explain, then the issue as to the chances of ending up with false positives increase quite a bit. But go ahead.
Could be, but again, I mean, it would, I say it would essentially bias against us finding anything, right? Because we essentially fighting against a lot of noise.
Well, you find, But go ahead, please. I was just wondering about your
sure.
perception about if essentially you're heading in the direction where you have a very low R square or not.
I think yes.
Okay.
I mean, we are. I mean, that's
Okay.
that we are, and you can see. I can show you.
Yeah, I'm sorry.
results.
I'm interrupting you. Sorry.
No, that's good. No, questions are good. I mean, that helps us a lot in thinking what we need to kind of explain more. But essentially, what we do is, so we take these first time in firms that are added to the index, the S&P 500 for the first time. Those are our treatment firms. We then propensity score match them with one control firm among this the universe of essentially listed firms. As a nearest neighbor matching. So we take the firm that is closest to the financial characteristics that essentially S&P also looks at when they make the decision to add the firm to the index, so that we get in essentially close to a control firm that is very close in characteristics to the added firm, index added firm, with a difference that didn't get added to the index. So in a sense, if our match is close enough, we essentially get to a control group and a control firms that could have been added to the index, but they weren't, right? And this way, hopefully can match on these financial characteristics. And we do this on a one-to-one, but of course, this is a match on observable characteristics, right? So there might still be unobservable differences that we can't control for. And then we run essentially classical difference and difference regressions in our context, because we're using a structural equation model. Then later on, it's easier to then run the regressions already in differenced form. So essentially, we're running the difference in difference, the double difference EAP on essentially the difference in guidance and a number of controls. And so the coefficient on guidance would then pick up the effect of guidance post index addition of the treatment firm compared to essentially the control group that didn't get added to the index on essentially the respective earnings announcement premium. Now, as we want to understand what the channel is, so what risk channel is affected by guidance, so whether it's reduction in information uncertainty or information risk or systematic risk, we can essentially run this recursive structural equation model and do a path analysis where we regress first the different risk estimates, so systematic and idiosyncratic risk on guidance, and then include systematic and idiosyncratic risk with guidance on essentially our main regression equation, and estimate this system of equations essentially simultaneously. One assumption here that is underlying this recursive structural equation model is that the error terms are not correlated, meaning that we essentially have to assume, to make this estimable, that guidance prior to the earnings announcement has an effect on systematic risk at the earnings announcement, but not vice versa, right? So that the systematic risk at the earnings announcement does not have an effect on the guidance prior to that earnings announcement. And we believe that's a fair assumption to make. So then we can run this path analysis essentially and this is the diagrammatic form, and we essentially expect, and distinguishing between raised and lowered guidance, we expect raised guidance to have a direct effect on the earnings announcement premium, which could be essentially through the increase in attention, but also has an information resolution effect directly. So the effect might be positive or negative. So that's an empirical question. But also have then through that improvement in because of the guidance, the information release, the nature of the information release, have a reduction of the systematic and idiosyncratic risk at the earnings announcement. So have an indirect effect through its reduction in risk, other than through this attention channel. And on the other hand, lowered guidance would have essentially an unambiguously negative effect we believe, because of the information value of negative news compared to good news. So it's unambiguously would reduce information uncertainty and do this indirectly through essentially a change in systematic risk as well as idiosyncratic risk. Now, this is our sample 2002 to 2018. We have 299 first-time index additions during that time, because we need, or for our estimation period, we need 2 years prior and 2 years post-inclusion to run our different diff. So we constrain it to 2 years prior to 2 years post. We essentially start from 2004 to then 2016, which has these 299 in first-time index addition. We have roughly 50,000 potential control firms that then are matched one-to-one based on the closest propensity score, which then leaves us with 230 treatment firms and 230 match control firms. In robustness checks, I don't have it in here in the presentation, but we essentially run also just simple panel regressions just to look at essentially correlations between EAP and the voluntary, so the positive and negative guidance, and we find similar results, not only limited to essentially the index additions, but to the larger sample. But again, those are just correlations that that don't have our identification, that don't have as strong as an identification as this setting.
What are the rough correlations?
I can show you. I'll show you in a second if I can.
Oh, it's okay.
I'll get to that. Let me get to that.
Yeah, it's okay.
So, okay, so now S&P obviously chooses to add firms to its index, and this is not, to some extent, not random. So if you look at it, there's a lot of there's financial firms and business equipments over time have been the ones, firms from those industries have been added the most. So this is essentially tech. And if you think about the changing composition of the S&P from 2002, it kind of makes sense that more and more tech firms have come in and more finance. We run tests excluding finance, and we find the same thing. So it's given that these are regulated firms and so on, people have said, well, have a look at whether that changes anything. It doesn't change anything over time, roughly evenly distributed, although there has been a lot more additions in between 2007 and 9, and then later on as well again. So one condition, of course, for to have a tighter identification is that this match that we do between inclusion group or treatment group and the match control group, that this match is actually good, so that there's a good area of common support. And this just shows you essentially the means of the firm characteristics that we match on. There are some differences, and so our treatment firms have higher ROA and also significantly higher market to book ratios, which is potentially why they have been added to the S&P index, and which also explains, is partly explained by the type of firms that have been added, right? If you believe that more tech firms have been added to the S&P 500, those are usually the ones with higher market to book ratios. So there are some differences in which we have to essentially be transparent about. There's just our the regression variables, the descriptives of the treatment firm. So we have different guidance. So we have essentially lowered and raised guidance. That are the ones that we particularly look at, and then our risk measures and controls for from characteristics. Let me show you kind of the main or the baseline regression. So the baseline regression is once if we essentially regress guidance, right? And to be clear, so these the guidance that we look at here is not the number, but just essentially the frequency of guidance. So whether or not a firm has provided guidance and how many. And the effect on the AP, we essentially don't find anything, right? So this is already in difference form. So this is essentially the double differenced estimator here, treatment minus control, post minus pre, and including all the controls. And there's no effect because
what are the main controls here? Do you have fixed effects there?
Yes. So we so the main controls are these. So we control for the timing.
What are the main ones that seem to be important?
I have to have a look at what actually loads, because we're already matching essentially.
Yeah, I mean, that sort of, in my mind, that seems to be very important. What does the baseline model look like? In other words, what are the control variables that are the most important?
Why are you interested in the controls?
Because you introduce something and you put it on the table. That's EAP here. Go to the next table.
Yeah.
Yeah. You have a dependent variable, right? EAP. And then you put in all of these controls. The question at hand is that what is it that's important? And what are the incremental explanatory power?
Okay. I don't have it here because it doesn't fit on the slide, but in the paper, so I can essentially, so the earnings.
My guess would be that if I think about the adjusted R square, it's all driven by the fixed effects. Am I wrong or right?
No. So given that it's adjusted R square, right? So it shouldn't be.
Yeah, that's no difference. Yeah.
Right. It shouldn't be driven by the fixed effects only, but essentially, this R square is driven, if you think about this. So what loads are essentially the earnings surprise, right? So of course, so in how much earnings are higher or lower than expected, than the consensus. So the earnings surprise definitely drives the EAP, and the bid-ask spread, and the number of analysts following. Those are essentially the control variables that load.
Yeah.
And then we have industry and time fixed effects in there as well.
Yeah, it's just a matter of that when I look at the table from my point of view, I would like to know what I should expect to see. And if I have controls, I like to know which are the controls that tend to be important.
Yeah, okay. We'll show those in the paper.
Yeah, okay, yeah.
Yeah.
Question from Lemino? Minia?
Yes, thank you. Sorry, just because I didn't get it in your previous table, we see the descriptive statistics for the variables used in the different difference regression for the whole period you examine. Is that correct?
Yes.
Okay. That's fine. Thank you very much.
Right. Well, it's for essentially 2 years prior to 2 years post, right?
Okay.
Earnings announcement.
Yeah. Okay. Thank you.
And so if you look at just guidance, essentially regressing EAP on guidance, you don't find anything, because there might essentially, as we split to the nature of the guidance, whether it's raised or lowered, then essentially you see that raised guidance has a positive effect on the AP and lowered guidance has a negative effect. And essentially they cancel each other out in this coefficient. And so this essentially tells us that lowered guidance, as we had hypothesized, has an unambiguously negative effect on the AAP through essentially reductions in information uncertainty or information risk, whereas raised guidance seems to have a bigger effect, a bigger positive effect, because of essentially that attention on that buying pressure channel. Now we can break this up into the different channels. So this is essentially this path analysis, so the structural equation model that we run. where if you look at, let's take the raised guidance, for example. So this coefficient here, the 0.197, is exactly this coefficient from this regression. And we can now look at the direct and indirect effects. So if you break it up into looking at what the indirect effects through these changes in risks are, we see that the direct effect is actually higher, and there's a compensating indirect effect through reductions of idiosyncratic risk. So if you were to essentially take these coefficients here, so 0.215, and plus essentially this coefficient times this, plus this times this, you get back to 0.197. This is just essentially decomposing the total effect into direct and indirect effect. So what this tells us is essentially that raised guidance has a positive direct effect on the earnings announcement premium through essentially net buying pressure, and a compensating negative effect through reductions in information risk, or through reductions in idiosyncratic risk that compensates for some of the positive effect. Whereas lowered guidance, again, that's the total coefficient from that main regression, baseline regression that I showed you. We decompose it, the direct effect is actually lower, and there's an additional negative indirect effect through reductions in systematic risk. So essentially lowered guidance reduces the conditional correlation or covariance of the announcing firm with the wider market, and also has an indirect effect, a direct negative effect because of the nature of the news.
So all of this is per your expectations. Did I get that correctly?
All of this is, well, our expectation was essentially...
Yeah, in other words, your prior hypothesis.
Yes, to some extent, right? Because we didn't really, on raised guidance...
No, I mean, it just would be interesting to know that you have certain expectations, and these expectations as to what you're going to find are either validated or it's not clear-cut, or... So
they're validated on essentially on the lowered guidance, and on the raised guidance, it was essentially our expectation, our hypotheses were ambiguous whether the attention or the information resolution effect prevails. So and hence empirically, it seems like the attention effect has prevailed in terms of the total effect being positive and not negative. But yeah, that's essentially in line with expectations.
Yeah, okay.
We try to tease that out in other ways, and in particular, just to triangulate the results, we use high frequency data. So what we do here, so we now look at a cross-sectional setting where we have nanosecond trading data on these firms, and we use this data to essentially build other measures of buying pressure and information asymmetries. Because in effect, if you look at essentially these results here, our hypothesis is that this positive effect is essentially an indication that it's the buying pressure that explains this, but we are not measuring buying pressure here in any direct way, right? So that's still essentially in a hypothesis. So to get to this a little bit more directly, we essentially look at proxies for net buying pressure. And in this case, we look at the ratio of essentially dollar value by transactions in a particular day. So all the buy orders in a particular day to total trading volume, right? Or total trading dollar value. And so this is our measure of net buying pressure. So in a particular day, the more essentially the higher the dollar volume of buy orders is compared to all orders, that obviously is reflective of buying pressure on that stock. So that should raise essentially theoretically raise the premium. And then we look at essentially the difference between this ratio during essentially the announcement period compared to the non-announcing, non-reporting period. And we do similar, create a proxy for information risk or information asymmetry, which is essentially the difference between the spreads, the bid-ask spread. But here we are looking at essentially the extreme spread, so how much the highest ask price deviated from the lowest bid price on a given day, which would tell you something about the volatility around this bid ask, and which is reflective of how much uncertainty essentially market makers have in pricing the stock on a particular day. When we do that, we can now essentially use we're using here now a larger sample, so this is not constrained to our to index additions. Actually, this is constrained to the index additions, and this is essentially what we find. So again, structural equation model where we regress guidance, net buying and extreme spread on guidance, on the different types of guidance, and then put everything into one regression on explaining either systematic or idiosyncratic risk. And what we find is essentially that raised guidance has a positive effect on net buying pressure. So as it was suggested by our initial model, and lower guidance actually has a negative effect on the information asymmetry. Again, similar to what we found in the other model, and these hence the extreme spread, essentially as information risk, is influencing the systematic and idiosyncratic risk around the earnings announcement, whereas the net buying pressure is not related to risk. So this essentially is a way for us to disentangle the risk-based and the attention-based explanation, and showing that that the direct channel that we have and the indirect channels before are essentially reflective of net buying pressure and information risk explanations. Now, we do a couple of other things that I don't have in here at the moment. As I said, we are revising, so we just look at the simple panel regressions, cross-sectional, and to see whether this still holds without essentially running a structural equation model. So that's and our results hold. The other thing that we do is that in this, now if I go back here, in this regression, and let's come back to the controls, one thing that of course we cannot or fully control for is all the other information that comes out between essentially the guidance and the earnings announcement. There's a whole lot of other things that can happen. So we do control for essentially bundled announcements, so whether these the guidance comes with other, or is at the same time as the earnings announcement, or comes with other information, and that doesn't seem to change the results. But to essentially proxy for all the other information, we also control for the stock returns between essentially the guidance and the earnings announcement that should essentially subsume or capture any information that comes into the market or is subsumed, and as an additional control variable, and the results also still hold, essentially. So that's essentially the paper. It's kind of a relatively simple paper in terms of the story, at least, in that we examine the effect of voluntary disclosure on the market reaction to earnings announcements, to these mandatory disclosures. And we want to essentially understand whether management guidance has an effect through essentially these hypothesized channels that were identified in the prior literature, and in particular, essentially the risk-based explanations of the AP versus the attention-based explanations, to identify this effect and make at least somewhat causal claims here, although you can always, it's just one way, and you can always argue, is we're using index additions, S&P 500 index additions, that essentially proxy for the fact that index-added firms have pressure to voluntarily disclose more, so there's exogenous variation in disclosure that we then use in this difference in difference regressions with a propensity score matched sample to to find essentially this this effect of guidance on the AAP, and we find that raised guidance has a positive effect, whereas lowest guidance has a negative effect. And we essentially look at the mediated effects through the changes in risk and attention, and do this also with high frequency data. And finally, essentially find that the attention-based channel essentially prevails for positive guidance, versus the risk reduction or information risk reduction prevails for the negative guidance. And in our mind, essentially, this study contributes to our understanding of these interaction effects between mandatory and voluntary disclosure, and essentially, in particular, by disentangling the nature of the disclosed news, we can essentially find that there are these opposing effects on whether these disclosures act as complements or substitutes, so whether there's a reduction or an increase in the earnings announcement premium. And that's the paper. I open for questions. Any other comments? Anything else you want to see? Any more cross-sectional tests? I don't know. What are you missing? Something you don't like the story?
I have a question. Many reviewers and editors nowadays ask you for economic significance tests. Did you engage in any so-called economic significance analysis?
We are at the moment not that explicit. We should be, actually. You're right.
Yeah, I mean, it's not my opinion that counts. All I'm saying is that at least in finance, people get back to you. In other words, right now, if you look at the regressions you're running and so forth, you get 2 stars and so forth. It looks very, very, very humble.
Yeah.
What you have.
I mean,
in other words, that would be one way of looking at it.
Yeah.
So nowadays, what we do is we get back to you and say, please evaluate the economic significance of the claims you're making. Normally, of course, people always say, oh, it's economically significant. But my question to you is if you plan to do it or not.
Yes. And the way we would usually do this is essentially, if you look at this baseline regression, you believe in the coefficient estimates, right? So and you think
no, but
about
the coefficient estimates have not really been discussed. It seems to me what you do, what you do as you presented, you focus on the stars.
Yeah, that's true. At the moment, I did not mention any economic significance. Should have.
Yeah, in other words, yeah.
That's
See,
right.
in other words, it comes back to my evaluation before. One of the concerns is that whatever your R-squares or adjusted R-squares you have, they sort of on the low end. Moreover, it could be the case that they basically just explained by the controls. Suppose that were the case, what would that affect your conclusions?
But well,
is my question clear? In other words, if you look at this table, we have controls Y and Y. So you use controls, and I get the impression that you have a lot of controls. And then I would say, well, that's going to really help you to get your adjusted R-square. So then I ask the question, suppose for the sake of argument that we just delete all the controls, what would happen to your adjusted R-square?
Yeah,
is that a fair question?
Yeah, that's a fair question. We can have a look at that.
Yeah.
But the mere fact that these coefficients are significant when you include all the controls means that not all the variation that essentially this R-squared picks up is explained by the controls, right? Otherwise, you wouldn't have any significance if it was all explained by the controls. The question is how much, right? So how much of this variation is explained by the
part of the problem, of course, is that the stars you have and the underlying t-statistics were horribly overstated in general.
Yeah, we're always very focused on
so there are other things one can do to really make the case that I have certain hypotheses, and they actually, in some sense, the conclusions are fairly solid. In other words, suppose for the sake of an argument that we replicated what you did 10 years down the line, would you then find the same thing? Right now, many people would say, well, the story you have may be, at least in your mind, fairly straightforward. But it seems to be that the underpinnings in terms of observations and so forth, some people would argue, are fairly fragile. So if we look at your basic hypothesis, the research question, it has fairly, quote, vague language. It's not very concrete. So therefore, one could argue that it would really, really help if you had some really basic statistics regarding the raised and lowered and how it affected things in the simplest possible way. Yeah. I'm just arguing, in other words, I mean, again, it depends upon who is reading and how much you care. But often what happens, I mean, what you can do too here is that, let's look at this table here. So you have two columns. Now, suppose you delete raised and lowered. Okay. Suppose you delete, how much would that affect R squared?
Yeah, you want the marginal. Yeah, we can look at the marginal contribution.
Yeah, but suppose now that you really can't, I think that's going to be the case. It will be pretty much the same at almost to the third digit. That's my guess. The point, you probably, if you delete raised and lowered, and I do my back of a napkin calculations, I suspect you're going to get 0.11. You're certainly not going to. Yeah, but then the issue that pops up is that, how do you view these problems?
How do I view these problems?
Yeah, in other words, it's sort of to get a sense of, what do I have here? I have a story.
I think
what does the evidence tell me about the story? It could be, well, it's sort of vaguely consistent, or it could be that no, it's really quite compelling, and that's for you to decide.
Yeah, and then, I mean, we can make that stronger, but I think the story here is, at least in my mind, I don't think, if you look at any study that looks at explaining essentially any measure that has stock returns, is based on stock returns, the R squared is low, right? So
no, that's fair enough. Yeah.
And so the question then is, what is the marginal contribution here, right? In terms of,
yes, correct. That's exactly correct.
Of the variation. And we can have a look at that. In terms of economic significance, though, if you look at the average earnings announcement premium, and we can have a look at the descriptive statistics, then is a question of how much raised or lowered guidance essentially influences that average EAP, right? So we can come up with some economic significance, which is, I think it's fairly.
No, you could, yeah. I mean, again, I'm not trying to tell you what you should conclude. All I'm saying is that these are the questions that are often asked nowadays. In other words, many papers get R&R, from what I'm told, because we don't have ES.
Actually, and Sirong just posted something in the chat, is that to answer your question, without raised and lowered guidance, the R squared of this regression is 0.06. So we're essentially doubling the R squared.
No, yeah, so that's actually, no, it's not the doubling. Yeah, so that's actually quite good.
Yeah.
That's quite good. Yeah.
Good. Well, thanks. So this is exactly what we need, because we obviously need to make that stronger in the paper in terms of highlighting economics.
Yeah, I mean, another thing you could do, again, it's easy to talk and suggest things, is that you could try some placebo aspects and show that if you don't get the correct synchronization on raised and lowered, then the effects disappear. That would be very compelling. So you can use placebos too. In other words, suppose you measure raised and lowered with a slight measurement error, then you would see that the number of stars should then decline or disappear. So that would be very compelling.
Yeah, I can't remember if you did the placebo test, but in terms of looking at, I don't think we did. but
Yeah.
we could, right? I think that's right.
Yeah, another thing you could do is that it's sort of my favorite. You could run standardized regressions. It's really quite helpful. Am I right?
Yeah, no, that's true.
Yeah.
That's true. Thank you very much. Thank you.
Yeah. I mean, I think that my overall impression, for what it's worth, is that it's a fairly straightforward story, but it's also a very ambitious story. Because when it comes down to it, you got to nail down things and convince people that you have fairly robust underpinnings in terms of the measurements.
Yeah, and that's particularly because it is such a straightforward story, right? And
yeah, but the story based on fairly vague nouns are tricky.
We'll be more precise going forward. Thank you. I think there was another. Did I see someone raising a hand?
No, but I mean, suppose for the sake of argument, you look at your basic research question, right? Then you could ask a third person, is it clear in your mind what's going to happen in the paper? And it's not, in my mind. It's not clear what we're going to expect to see.
No, that's true. Yeah, I mean, and that's I mean, that's the tension, right? In the hypothesis, I think that's right. Which I'm very comfortable with.
It reduces the tension because you get vagueness.
I mean, it's an empirical question, right? I mean,
we
have hypotheses, but they are essentially
empirical questions need to point to these are the schemes used to get the measurement. So let's take, for example, just betas. It could be the case that your conclusions depend upon how you estimate the betas, right? It could be.
Well, we can obviously then we can easily alleviate by doing different methods of estimating the betas, right? I mean,
correct. That's exactly correct.
Okay.
But again, my kind of comments are very cheap because I don't have to do anything. All I'm saying is that when I digest it, is I see a fairly straightforward hypothesis, but it's resting on a literature that's been, per grapevine at least, harder to replicate. And then you juggle all of these notions, all of these concepts, voluntary and non-voluntary disclosure and so forth. They sort of semi-vague in some people's minds, and you have guidances, and so the question at hand is really that suppose you gave this to your research assistants and you said, I want you to replicate this research without giving any details. I think they would have some difficulties doing that, not because there's anything going wrong, but because there are too many decisions lurking in the background.
Yeah, and I agree, and one should be very transparent about those decisions taken.
Yeah, it's hard. It's hard. It is.
I think that's true.
Yeah, but good luck.
No, thank you. We will need it.
Yeah. Nowadays you do need it. Yeah, well, because I get a lot of feedback and people are complaining a lot about this ES. But of course, there are schemes in place of the ES economic significance. They should always work out if you follow proper procedures. They checked into it in finance. It's a little bit like robustness tests. They always work out. Don't worry.
Lemonier.
But the asymmetry is very interesting. Yeah. Sorry.
Sorry, there was a question.
Okay, thank you. So apologies if I missed that, but I am wondering that have you conducted any robustness test to validate the parallel trend assumption?
Yeah, we haven't included it. So essentially, you're saying whether our treatment and control already had different trends in the disclosure prior to exhibition, right?
Yeah, I mean, except for the difference in means, because as you know, the recent literature so that this is not enough to validate the parallel trend assumptions, and there are many developments in this
yeah, that's true.
kind
And
of test.
we just recently, Tsirong has run some regressions. So essentially, you can do this you can stack everything in event time, and you can show essentially what the trend is in the 2 years prior, right? Treatment versus control minus compared to the post. So what you could do is, instead of having looking at the difference in difference post minus pre, you split it up into every year, for example. We could do every quarter as well, and then have it in event time, and then see how what the coefficient trend is. And what you would expect if it's a parallel trend is that you have insignificant coefficients in the prior period, right, and then significant as we find in the post period.
Yes.
So yeah, we have done this, and there's essentially no significant difference in the prior period. We just need to report it.
I see. And also, have you also considered if there are any confounding effects that might affect your results, except for the identification strategy you are using?
I mean, one of them was essentially, there might be many, right, in terms of, because we're looking at information disclosure in markets, there might be a whole lot of other information that is being disclosed, right? So we're controlling for all control variables, right? The timing, you name it, bid-ask spread, and so on. But there might be other things that where there's simultaneous disclosure. So one thing that we do is we look at whether there is simultaneous disclosure, and then control for the occurrence, right? So whether there is or not. And then the other thing was, as I mentioned, is that we look at the stock returns between the guidance and the earnings announcement, because so we are essentially claiming, right, that the earnings announcement the guidance has an effect on the earnings announcement. But if there's more information coming out after the guidance has come out before the earnings announcement, that might also obviously affect the earnings announcement premium. So we essentially control for the stock returns in that period that might capture, that are correlated with any information that has come out, right? It's one proxy that we can use. Again, hasn't really changed much in terms of the results, but there might be other things.
Yeah, maybe I ask again because I don't remember your sample period, please.
Sorry, again, the sample period?
Which is your sample period? Yeah.
It's a 2002 to 18.
Okay, but maybe also, the financial crisis might be a confounding effect, or I don't know. So, if you can conduct a regression and maybe exclude the year of the crisis, or split
we could, but then that would essentially, this is to some extent the beauty of a difference in difference, as long as both treatment and control group are affected in the same manner by the financial crisis, and I wouldn't see why it wouldn't be, right? That is different. Any effect is differenced out, right? Because you're differencing. So whatever effect is essentially affecting the treatment group is also affecting the control group in the financial crisis, right? So, and if you difference that out, it's differenced out.
I see. Okay. Yep. Thank you very much.
No, but thanks for the comments. But we can have a look at others. Still, here a comment.
Yeah. Yeah. Thanks a lot for the presentation. First of all, so I have some questions and comments. So first thing is, these index inclusion events, right? So you're basically reusing a experiment. So I wonder whether this is an issue, because, right, there's this Journal of Finance article, for example, which describes certain methods which need to be adopted when an experiment is reused. So have you talked about that already?
The recent one, I mean, yes, but essentially, as far as I know, there's only been one paper that essentially has used index inclusions and looked at disclosure, voluntary disclosure.
Oh yeah, okay.
So, but yeah, I know, right? So there's this recent paper that looks at, because as soon as people find an instrument, right, then there's like tons of papers that are based on the instrument. So what does that mean in terms of how we interpret the p-values, right? And as you're repeating, essentially, we can have a look at that. Actually, that's a good idea.
Yes, I think just the threshold is a bit higher, right? So
Yeah,
you need to make sure that.
Yeah.
And for me, it was not really clear whether these index inclusions are now an instrument or not, or if it's a difference in difference approach. So that was a bit hard to understand for me, especially in the beginning of the presentation.
Okay, yeah, it's actually difference in difference, right?
Yeah, so it's in difference because on one slide you also noted that it's an instrument. I think. Well, okay.
Just write down. Okay.
And at least what would help me a lot is just to display like the normal difference in difference coefficients. So I like the design and already using like difference values. So I think that's super convincing and clear, but you need to put in a lot of effort first to understand what is going on. And I think when you just see like a treatment dummy and a post dummy, it's maybe easier to understand what is actually going on. And maybe that would be an idea to also start showing with these simple estimates.
Sure. Thank you. No, we can do that. Absolutely. Thanks very much. Any other questions?
Thank you very much, dear Professor Amir, for your contribution and your effort. It's really an excellent presentation and excellent paper. Thank you very much. And thank you everyone joining us today.
Sorry, Dr. Muhammad, I have a question, please. I raised my hand.
Yeah, you
from
can.
my wife. Okay.
Sure,
okay, can I speak now?
Yeah.
First of all, I thank you and thank Dr. Amir about this very informative presentation and send my greetings for all audience. And I have a question about which software Dr. Amir used in this analysis. Can I have the answer, please?
For the structural equation modeling, I think Seong, you're using R, right? But you could use, I mean,
which one?
R?
R?
Yeah. But you could use Stata
like
or
SPSS or you, it's including SPSS.
No, R is a separate, it's like an open sourced statistical program that you can use. But you could use Stata as well. I'm not sure if SPSS allows for structural equation modeling. I haven't used SPSS.
It's a kind of event study because it's used 2 years before and after. I think it's a kind of event study methodology or what?
I mean, to some extent, yes, but not quite, right? It's kind of a traditional difference in difference setting, right? So you have essentially a treatment that affects one set of companies, but doesn't affect another set of companies, and then you can use that treatment that here in this case, the index additions, could be anything, a regulatory change, and hence you can then use essentially one as a treatment group, one as a control group, and look at essentially how this treatment has affected the treatment group differently compared to the control group. That's essentially the setting.
Okay, thank you, and thank you again for your presentation.
Thank you. Thanks.
Interesting one.
Thank you. Thank you very much, dear Professor Amir. Thank you, everyone joining us today. It's been really appreciated. Thank you very much.
Thanks.
Yeah, and I hope
Thanks,
to see you soon in Egypt. You are very, very welcome.
Thank you. I'll try to make it. Thank you. And thanks, James.
Thank you. Thank you.
Yes, for sure. See you in Egypt, inshallah.